Countrywide headquarters in California. She has the exclusive interview with the company's chairman and CEO. We want to turn it over to her now. Maria.
Hi there, Trish, and thanks very much. We are on the trading floor right now of Countrywide Financial, and I'm here with Chairman and CEO Angelo Mozilo. Angelo, nice to have you with us.
Nice to be with you, Maria.
Thank you for joining us. We know that this has been a pressured period. How did the $2 billion strategic investment come about?
It came about as a result of a long relationship with Bank of America, and Bank of America contacted us and said they would like to help and come in to talk to me, and I spoke to Ken and to his colleagues, and since we've had a long relationship, our relationship with Bank of America goes back to 1969, actually. My first line of credit for Countrywide was with Bank of America.
You borrowed $75,000 from Bank of America
to start Countrywide.
To start Countrywide
That's
Financial.
Right.
So this is really, on a personal level, must be incredible for you.
Yeah, it is.
This relationship. Let me ask you about the terms of the convert. This, of course, is being talked about quite a bit today on Wall Street. It's already in the money. It's a high coupon. Obviously, this is a very attractive piece of paper for Bank of America. The terms are not so great for you.
Yeah, well, I would disagree with that. I think the terms are great for us. I think it's really a win-win situation for us. First of all, for Bank of America, a world-class firm, largest retail bank in the United States, to come into Countrywide, do their extensive due diligence with a very professional team, and come away saying, we like what we see, and we want to invest $2 billion, is a great endorsement for what we believe we have here at Countrywide, one of the strongest and best-run companies in the country. So it was important from our viewpoint for somebody of that caliber to give us the vote of confidence that was needed in this environment when everybody was in a panic and things were being said about Countrywide which just were not true. So from our viewpoint, that is a priceless endorsement for us. For a long-term shareholder, this is the best deal, for a long-term shareholder of Countrywide, the best deal that they can have, to put Countrywide back on a strong footing so we can move forward. It's true, if you're looking at Countrywide from a short-term flipper type of thing, get in, get out, maybe that doesn't appear to be a great deal, but I'm not interested in those people.
How much time does this buy you, Angelo, at this point? People, I mean, the Merrill Lynch report last week coming out, floating the word bankruptcy out there. What will determine whether this, along with the $11.5 billion drawdown, the credit line, will in fact be enough?
Well, first of all, let me kind of comment on a couple of things. One is just the irresponsible behavior on a part of that analyst from Merrill Lynch to yell fire in a very crowded theater in an environment where you had panic already setting in the overall markets unrelated to Countrywide was totally irresponsible and baseless. And it affected the lives of 61,000 people here at Countrywide, our employees, and more importantly, or as important, our depositors. Our depositors are primarily senior citizens who stood online, frightened to death that Countrywide was going bankrupt, to withdraw their money. It was all caused by that individual at Merrill Lynch and had no basis in fact whatsoever. We have a very strong bank, well overcapitalized, access to the Fed window for whatever they need.
No, he had can you, I mean, for the investors watching who had access to that report, can you categorically say we will avoid bankruptcy?
Well, I can't categorically say, no company can say they can avoid bankruptcy because no company, it can be guaranteed they can't go bankrupt. But I can tell you that there is no more chance for bankruptcy today for Countrywide than it was 6 months ago, a year ago, 2 years ago, and when the stock was $45 a share. We are a very solid company.
Talk to us about the environment overall. You have this liquidity right now from B of A and the drawdown that we talked about. Have you seen any change in liquidity? How tight is this credit crisis?
Well, speaking for credit, there's been no change. I don't believe in the marketplace there's been much change in liquidity, despite the efforts of the Fed. I think that unless the Fed does some more things, I think one is to acknowledge that there's a serious problem out there in housing, which could spill into the overall market, and that the Fed chairman is really looking at that and concerned about it and paying attention to it, and maybe symbolically to lower the rate to really demonstrate that there is a concern.
Is Bernanke not getting the right information?
I don't know. I'm not inside the house there, so I don't know. I think that they're working off of data. I think their tendency is to work off of data, and data is always, it tells you what happened. It doesn't tell you what's happening. We know what's happening. And so I think that that's why you get these delayed reactions. But I think from my perspective, it's a very serious issue going on in housing. Increased delinquencies, increased foreclosures, no liquidity, Fannie Mae's capped. They can't participate to the level they should be participating at, not because of leadership, fantastic leadership, but because of the regulator who's got the caps on them. So we still have a tremendous liquidity problem. Now, some of the loans that were made in that 5-year period should not be made going forward. I would acknowledge that, no question about it. But there are many loans that should be made today that can't be made to legitimate buyers who need housing, particularly in the lower income and minority area, that we're not making, and that's unfortunate.
How long does this cycle take to work itself out?
If I knew that, you and I'd be interviewing in the south of France, not here in Calabasas. So I don't know, but it seems to me, I mean, I don't see a light here at the moment. Now, again, something can happen, can change that overnight. But it appears to me that we've got a way to go to work our way through this opportunity.
And how do you work your way through it? What needs to be done? You said you need the caps to be lifted for Fannie and Freddie. What else needs to be done?
I think, well, first, the panic has to go away. I mean, the confidence has to return to the market. What's driving this is form. It's not real. A lot of what's driving this is this lack of confidence, this panic. This is one of the greatest panics I've ever seen in 55 years in financial services. And so something has to be done to restore the confidence in the market. If we turn that around, because most of this, again, was driven by form, not substance, but form has become substance. You know, the whole fear has become real. People, when you have a 2-handle on a 1-year T-bill, you know, the other day, you know, that means all the liquidity is going into T-bills. That's how panicked this market is.
Right.
So we have to have some turn of events that will create liquidity back into the mortgage space, particularly at this time. We're originating the best quality of loans we're originating in 10 years. At the best prices we're originating in 5 years, and yet nobody wants to buy them. What
happened over the last 2 months when you were calling on banks to help you or to access capital? Tell me what kind of a reception you got.
Well, you know, I think I would characterize it as these banks, the big banks we deal with, been dealing with for many, many years.
These are banks you've dealt with for 40 years.
Right, that's right.
What did they say to you?
They said we have our own problems, you know, and so they were restricted, and they did. They had their own issues, so they couldn't be as accommodating. But what happened was it started this way. It started with commercial paper. Commercial paper started to dry up. And so our oxygen, what we live off, is commercial paper, repo lines, medium-term notes. That's what we do. And because most of our business is not done in the bank. It will be, but it's not done in the bank now. And as a result, we rely upon those 3 instruments. Well, commercial paper started to dry up, lack of confidence, concerns over subprime. That subprime thing, CNBC, all of us all you heard is subprime. Believe me, there was never that amount of subprime loans being done in this country, ever, but you would think that every loan was subprime. That began to have a material effect on the psyche of the market, and everybody thought everything was subprime. Commercial paper started pulling back. Then we had to rely more on repo lines. The pressure of all mortgage companies, providers were on the banks. We need a lot of asks from the bank. They had limitations on what they could do, and they began pulling back, and that began, you know, a whole series of events that led where we are today. And you got to remember that we're a survivor. You're interviewing me. I mean, you look at, you know, the other day, Greenpoint, New Century, AmeriQuest. We just go right down the line of companies that have been around for years are gone. American Home, Home Bank, all these companies are gone. So it has had a material effect on the market. Now, in one sense, that's good news for country. I hate that happening to anybody, but at the end of the day, we're the only game left in town.
50-plus years in the business, have you seen that housing does not take us in or out of a recession?
That's right.
Is housing going to take us into a recession?
I think so. I still think so. I know I've been proven wrong so far, but I can't believe that when you're having a level of delinquencies, foreclosure, equity's disappeared. I mean, equity's gone. The tide has gone out, that this doesn't have a material effect, A, on the psyches of the American people, and eventually on their wallet.